Ever found yourself wondering if you could, actually take over someone else's mortgage? Or maybe give yours to someone else when you sell? Sounds a bit wild, right?
Course.
Like some kind of financial magic trick.
Yeah.
But believe it or not, it's a real thing sometimes. It's called a mortgage transfer.
Hmm.
And today on the Deep Dive, our mission is to really unpack this. We want to get into the how, the why, and the when an existing mortgage can actually move from one person to another. We'll try to turn what seems like this really complicated financial maneuver into something clear, something actionable for you.
Exactly. And it's fascinating because, while it might sound pretty niche, understanding these transfers can actually be a strategic lifeline for homeowners. Or, on the other hand, a golden opportunity for buyers. We'll dig into the preconditions, the benefits, and those really critical clauses that determine if a mortgage is what they call assumable.
Okay, let's dive straight in then. What is a mortgage transfer at its core? How does this actually work?
Well, at its simplest, it's basically reassigning an existing mortgage from the current owner, the borrower, to someone else. The key thing is you're not getting a new loan here. The new person, they just step into the shoes of the original borrower. They take on the original terms, the payment obligations exactly as they are. Same interest rate, same remaining loan length. They're just responsible for whatever balance is left.
Ah, okay, so it's like inheriting the loan, not starting fresh.
Hmm.
What's the big appeal then? Who really benefits from doing it this way?
Oh, the appeal can be huge, especially in certain markets. It can be a win-win. For a homeowner maybe struggling with payments, it could potentially help them avoid foreclosure, which is massive. It gives them a way out without that severe credit hit. But for the new owner, the buyer, the benefits can be really significant, especially, thinking about recent interest rate hikes. Two main things jump out. First, lower interest rates. Imagine grabbing a mortgage from a few years back, locked in at, say, 3 or 4%.
Wow, yeah,
Yeah.
compared to now.
Exactly. If current rates are like 7 or 8%, the savings are enormous. We're talking potentially hundreds of thousands over the loan's life. Your monthly payment is just way lower.
Okay, that's a huge draw. What's the second thing?
Reduced closing costs. Getting a new mortgage usually means paying thousands in fees, right? Origination, appraisal, title insurance.
Mm-hmm. They add up fast.
Right. With an assumed mortgage, because you're not originating a brand new loan, a lot of those costs can be much lower or even disappear entirely, big upfront saving. But, and this is really important, not every loan can be transferred like this. Only specific types, known as assumable mortgages, allow it. You have to check the details.
That really does sound like a great deal. Almost too good to be true in some ways. I'm guessing lenders aren't just letting people swap these valuable low-rate loans without some checks, right?
You're absolutely right. No way. The lender needs to protect their investment. So even though the terms stay the same, the new borrower has to qualify. They'll go through underwriting income checks, credit history, the whole deal. The lender needs to be confident they can actually make the payments. Which brings us to the big question. If it's such a good deal, what stops all mortgages from being assumable?
Yeah, this is where it gets really interesting for me. If it can save sellers from foreclosure and give buyers these amazing rates, why isn't everyone doing it? I've heard about something called a due-on-sale clause. Is that the main culprit here?
That's exactly it. The due on sale clause is the primary gatekeeper. It's written into, well, the vast majority of mortgage agreements today, especially conventional ones. Basically, it's a rule the lender puts in. What it means is, if the property is sold or transferred, the clause requires the entire outstanding loan balance to be paid back immediately.
The whole amount at once.
The whole amount. So the seller has to pay off the loan, usually from the sale proceeds, and that forces the buyer to get their own new mortgage at current rates. It effectively blocks the transfer of the old, potentially lower rate loan. It lets the lender reassess risk and adjust to current market interest rates with the new owner.
Okay, so that clause sounds pretty definitive. If the property changes hands, the loan gets called due. End of story. Or are there cracks in that? Are there exceptions?
Now you're getting to the really crucial details. Yes, there are exceptions. While due on sale clauses are common, lenders cannot legally enforce them in certain specific situations, even if ownership changes. And that's mainly thanks to a piece of federal law from 1982, the Garn-St. Germain Depository Institutions Act.
The Garn-St. Germain Act of 1982. Okay, that sounds important. A key piece of legislation for listeners maybe facing this. So what specific scenarios does it cover? When can that due on sale clause be, bypassed?
Absolutely. It came about during a time of really high interest rates, actually. Congress wanted to protect consumers in certain non commercial situations. It outlined several key exceptions where the lender's hands are tied. One is family transfers. So, transferring the mortgage to an immediate relative, like a spouse, child, or even an ex spouse after a divorce. The law protects these kinds of transfers.
Okay, family situations. Makes sense.
Another big one is inheritance. If a relative inherits the home after the borrower passes away and moves in, the lender generally can't enforce the due on sale clause. It prevents the family from being forced out just because the original borrower died.
Right, that seems fair.
And the third main one involves living trusts. If you transfer your property into a living trust for estate planning and you remain the beneficiary, the mortgage usually can transfer too. The idea is the beneficial ownership hasn't really changed in a way that increases the lender's risk.
Wow. Okay, that's a powerful set of exceptions then. So it's not always a definite no just because that clause exists. Does the type of mortgage itself also play a big role here, like regardless of Garden St. Germain?
Yes, absolutely. That's the other major factor. The origin of the loan matters a lot. Some types are designed to be potentially assumable, often government-backed loans. So FHA loans, Federal Housing Authority, USDA loans, debt for agriculture for rural areas, and VA loans, Veterans Affairs. These are often assumable.
Why those specifically?
It's part of their policy goal, really,
Right.
to help specific groups, first-time buyers, rural residents, veterans, achieve and maintain homeownership. Assumability makes these loans more flexible. Now, the new borrower still has to qualify with the lender, credit check, and all that, but the option is often built in.
Okay, so FHA, USDA, VA loans are more likely candidates. What about the rest?
Well, conventional mortgages, the ones not backed by the government, especially those bought by Freddie Mac or Fannie Mae, they generally do not allow assumptions. The lenders and investors behind these loans want the ability to adjust the interest rate when the property sells. So they almost always include and enforce that due on sale clause outside of those Garden St. Germain exceptions.
Got it. That distinction is critical.
Yeah.
So if you're listening and thinking about this, how do you find out which category your loan falls into, or one you might want to assume?
First step always, dig out your original mortgage paperwork. Look for that due on sale clause. Is it there? If it is, then you see if any of those Garden St. Germain exceptions might apply to your situation. The family transfer, inheritance, living trust ones. Beyond that, if you know it's an FHA, VA, or USDA loan, your odds are better. The best way is to contact the current loan servicer, the company you send payments to. They'll know the specifics of your loan and what the process is for assumption, if it's allowed.
Okay, that's clear. Now, we've talked a lot about transferring the whole mortgage. What about something slightly different? Can you just add someone to an existing mortgage, like a co-borrower, maybe a spouse or partner later on? Is that a type of transfer?
Good question. But no, not really in the way we've been discussing. Once you have a mortgage in just your name, you generally can't just bolt someone else onto that specific loan. To add a co-borrower, you almost always have to refinance.
Refinance, meaning get a completely new loan.
Exactly. Pay off the old loan, get a brand new one with both your names on it, subject to the lender approving both of you based on current income, credit, and rates. So while lenders allow co-borrowers on new loans all the time, adding one later is usually a refinance situation, not a simple transfer of the existing terms.
Okay. And what about something, well, even less formal? Let's say someone just starts giving the homeowner money each month to help cover the mortgage payment. No official paperwork, just a private arrangement. Is that like an unofficial transfer?
People definitely do that, but it's really important to understand it's not a legal mortgage transfer at all. It's just an unofficial arrangement. In that case, the original homeowner is still the only one legally on the hook for the mortgage. They make the payments to the lender. The person helping just gives them money.
What are the risks there? Seems precarious.
Hugely precarious. For the person giving money, they have zero legal claim to the house or the mortgage. If the homeowner stops paying the lender or sells the house, the helper could be out all that money. And for the homeowner, they're still 100% responsible to the lender. If the helper stops contributing, the homeowner still owes the full payment. There's no legal protection for either party in that kind of setup. It's very risky.
Yeah, that sounds like something to avoid, if possible. So let's loop back. If an official legal mortgage transfer is impossible, maybe it's a conventional loan or the lender says no to the new person, what are the other more standard options for someone struggling and trying to avoid foreclosure?
Right, because transfer isn't always an option. What next? There are several key alternatives homeowners should definitely explore with their lender. First, negotiate with the lender. This should always be step one. Talk to them. They might offer forbearance, which is like hitting pause on your payments or reducing them for a short time while you get back on your feet.
Okay, temporary fix.
Or they might discuss a loan modification. This is more permanent. They might lower your interest rate or extend the loan term to make monthly payments more manageable long term. Lenders often prefer this to foreclosure.
So working directly with the lender is key. What else?
Well, they're selling the home. This is obviously a big step, but it's a common way to resolve the debt. You
Yeah.
sell it, use the money to pay off the mortgage. If you owe more than the house is worth, you might need to look into a short sale, where the lender agrees to accept less than the full amount. It still impacts credit, but usually less than a foreclosure.
Right. Selling is an option. Any others?
One more is a deed in lieu of foreclosure. This is where you basically agree to hand the house keys back to the lender voluntarily. You sign the deed over. It avoids the formal foreclosure process, which can be better for your credit in the long run compared to a full foreclosure, but you do lose the house. Again, requires the lender's agreement.
Okay, so there are definite pathways, even if a transfer doesn't work out.
Yeah.
So wrapping this up, what does this all mean for you, our listener? We've seen that transferring a mortgage, well, it isn't simple. It really boils down to the type of mortgage, that due on sale clause, and what the lender requires from a new borrower.
Exactly. Your conventional loans, especially Fannie Mae or Freddie Mac-backed ones, usually no go on transfers. But those government-backed ones, FHA, USDA, VA, they might be assumable. And don't forget the Garn-St. Germain Act. Those exceptions for family, inheritance, and trusts can be lifesavers, overriding the due on sale clause in specific cases.
So the takeaway really is, understand your specific mortgage, read the documents, know the rules, and know the alternative if a transfer isn't in the cards. It's about being informed to navigate these big financial moments.
Precisely. Knowing these details gives you power. It prepares you, whether you're thinking about selling, looking to buy, or just want to understand the full picture of your own home loan. It's crucial knowledge in today's housing market.
So for you, our listener, here's something to think about. In this world of constantly shifting interest rates, could the assumability of a mortgage or the lack of it become a much bigger, maybe overlooked, factor in how we value homes going forward? Could that low, locked-in rate become a major selling point itself, changing how real estate markets work? Something to mull over.